Andrew, thank you very much for that introduction. I'm going to try to give you a quick overview of this report. It'll take 25 or 30 minutes or so. I'll be skimming over some of the slides in the interest of time so that we have enough time both for the discussants and for you, but don't hesitate to come back to the issues that you're particularly interested in once we get to the discussion. The report is quite a rich one. It has an overview, and that's what I'm going to focus on, but it also has two specific chapters, one on the banking systems in Africa, contagion from Europe, how resilient are they. I'm going to say very little about that now, but I'll be happy to talk about it later. And it has a second detailed chapter on natural resource management and the issues that brings forth. And again, a topic that one could have multi-day conferences on. I have 5 slides, but I'm happy to talk about it in more depth afterwards. So let's and this is going to be the outline of my talk. So against the global backdrop, what's the outlook for Africa? What are the risks that Africa faces? A little bit on natural resource management and what those challenges are, and finally what this all means in terms of economic policies. This is the way the IMF sees the prospects for the world economy. On the left, you have the advanced economies against well below the world average. The red line here is our projection for the world, which is around 3.5–4% growth in 2012–2013, with the advanced economies growing at a far slower pace. And in the right-hand chart, you see that the emerging and developing countries are growing well above that pace. And it is this dichotomy in the world economy which has, in the past few years, been creating an increasing amount of tensions and also reflects the uncertainty that's in the title of this presentation. This heat map shows it maybe a little bit more attractively. Here you see the countries that are going to grow at 4% or more are in blue. You expect them to be in emerging Asia, but as you can see, most of Africa actually belongs in that category, and of course some of South America as well. This leads me to what does this mean for sub-Saharan Africa in particular. And when I'm going to be talking about sub-Saharan Africa, I'll often be referring to different groups of countries, and this is the kind of breakdown that we use in our report, because different groups of countries are often affected very differently. So you have the oil exporters, the Nigerias and Angolas of the continent, which face often very different issues. And then we split between middle income and low income countries. Middle income includes obviously South Africa, but it also includes some countries that are not quite as middle, but are definitely above low. I'm thinking here of Senegal, I'm thinking of Ghana, I'm thinking of Zambia. And as you can see from this breakdown, while the low income countries account for more than half of the population, they only account for about a quarter of economic output, and that's something to bear in mind. They don't always show up as heavily in the averages, but if you start to look at individual countries, they can be very heavily affected by certain developments. The bottom line for the IMF is that we expect economic growth in sub-Saharan Africa to remain quite strong in 2012 and 2013. Our projection is of about 5.5% growth in both years. That's the black line in this, as you can see in both charts. Now, around that average, the country groups that I just referred to actually do quite differently. Most notably, you can see that the middle-income countries, which have suffered a far sharper recession in 2009, are growing more slowly. This is essentially a South Africa effect. And you can see that the low-income and fragile countries are growing above average, many of them around 6% or so. You can also see, and this is the right-hand panel, that African growth is, well, the IMF projections are concerned, is well above the world, but it's also above developing countries in other parts of the world. So from the IMF's perspective, Africa continues to be a positive story. Again, a heat map tells it maybe in a little bit more of an appealing way. Here the blue countries are countries that are growing at, or are expected to grow at 6.5% or more. It includes a number of natural resource producers, Nigeria, Angola, but also Congo, Zambia, for example. But it also includes countries that are not so dependent on natural resources, for example, Mozambique, Côte d'Ivoire, and Ghana. And we'll get a little bit into that later, but the story I think I'd like to tell here is that you have a fairly large number of countries that continue to grow at fairly solid rates. A chart that I didn't include here, but that we've included in previous reports, that if you look back to 1995, for the past 15 years, you will find average growth in Africa of somewhere between 5 and 6%, and for a number of countries, well above that. So this is not a recent story, it's a story that's now lasted for 15 years and for somewhat longer in some countries. Now, where is this growth coming from? What are the underlying factors? There are, of course, commodity prices. And the chart on the left shows you in blue and in green, it shows you oil, it shows you metals, and this has certainly been an important factor. But I think in the light also of the long period of growth that many countries have enjoyed, it's not only a commodity story. For example, on the right, again in blue and in green, these are the middle-income countries and the low-income countries. You can see that capital investment has been continuously rising. In the case of low-income countries, from 16% to 23% of GDP, and you know, while still lower than China, this is a very positive trend, and this has created more productive capacity, and has created a more sustainable base for growth. Two other factors, for example, are credit to the private sector. And again, we all think of financial sectors in Africa remaining relatively shallow. It's true, but they've also been growing from a low base, but they have been growing. And here you can see that credit to the private sector in an unweighted average has gone from about 10% to nearly 20% of GDP over the last 15 years. And that has been able to sustain both the investment that we saw before, but also increases in employment. We also try to measure average labor productivity growth. Immediately inject a caveat on the data here, but this is about as well as one can do. And the story that I would like to extract from this chart, Sub-Saharan Africa is the orange bar. That before 1995, productivity growth in Africa was negative. It has since been rising, and in the latest period, on the data available, it's second only to Asia, by a long measure for sure, but the trend is clearly positive. So again, we have a contribution to growth from capital, from labor, from the financial sector, as well as commodity prices. I think that's the story I'd like to take away from these charts. These charts to show that Africa, of course, is also subject to severe shocks. Food and fuel prices, a topic that I'm sure has been discussed here over the last couple of years. Many African countries are very sensitive to that. And in particularly the food price shocks, I should say, first in 2008, 2009, and then in 2011, it has an important impact on countries. And as you can see in the right-hand chart, it can also lead to inflation that goes beyond simply an increase in prices, but it's sort of second-round inflation where high food prices lead to prices rising across the economy. East Africa has been very much affected by that, and I'm sure Razia can talk about it since this is very much a factor in economic policy in those countries. And so you've seen, from low levels, you've seen inflation go up to above 30% in Ethiopia, and also in Uganda. And so this has been quite a challenge for the policymakers. And you can also see in these graphs that it's coming down, and that's been a result of tightening of monetary policy in many of these countries. But it's a severe challenge, and as we know, inflation hits the poor particularly hard. And another factor that has been helpful for sustained growth in Africa, and has been particularly helpful during the global economic crisis, has been the relatively strong fiscal positions. Let's start with the chart on the right, which is government debt. The black line is the average, or the median, I think. It's the median. So the median average, the median level of debt in sub-Saharan Africa has fallen from about 100% in 2000 to around 40% today. Very positive development, a lot of it due to debt forgiveness, but also to disciplined fiscal policies in many countries in recent years. And what's equally important and I hope you can see this on the chart, is that the distribution around the median, the light blue and the somewhat darker blue, has also narrowed. So you will find that most countries in sub-Saharan Africa today have government debt somewhere between 25 and 40% of GDP. And that relatively low level of debt, compared to close to 100% of GDP in many European countries today, as you know, with all the consequences thereof, that relatively low level of debt has given countries room for maneuver. And that's what the left-hand chart goes to. During the global financial crisis in 2009, many African countries were able to let deficits widen, kind of Keynesian counter-cyclical response, if you will. Revenues fell typically because the economy slowed down, and for a while commodity prices fell, so you had lower government revenue. Instead of having to cut spending, which is what many African countries had to do in the past, they could maintain spending, even increase spending. I think by our count at the time, around 2/3 of sub-Saharan African countries were able to let deficits widen quite significantly during that period. And many were able to even increase health and education spending despite lower revenue. And that worked like a shock absorber. That really maintained growth, and I think it's a very positive story for Africa. It also is a reminder of how important it is to have those buffers, to have those margins, because the shocks are inevitable, and if you're a low-income country, they're probably even more inevitable, if you will, or they're going to be more severe than they would be if you are a richer economy. So thinking about that, also looking forward, I think it's important to rebuild the buffers to the extent that they have been diminished. Well, finally, the bottom line, of course, in low-income countries is what does this all mean for poverty? And you can see in the top 3 bars that there has been a reduction in poverty as far as we can measure between 1990 and 2008. That's from green to the red bar. But it still falls well short of the target of the Millennium Development Goals, which is to halve headcount poverty by 2015. So progress, yes, but not fast enough. Other parts of the world have made faster progress, notably in East Asia. This is certainly a China effect, but you can see how rapidly poverty has been coming down in East Asia, already well beyond what the goal was under the MDG. So this is a relatively rosy picture, you could say. This is a relatively rosy picture. Now, it's not without risks, and the report spends quite some time on it, and I'll try to summarize it for you. The main 2 risks that Africa faces are the main 2 risks that the world economy faces, and the number 1 is surely the euro crisis. Here are some charts that try to depict visually what that means for Africa. And the left-hand one is a fan chart where we try to estimate some probability distribution around the central growth projection. The central growth projection is, as I said, 5.5. And you can see that as fan charts go, this is a relatively wide fan chart. What does that mean? Well, it means uncertainty around this central projection. Maybe more interestingly is the chart on the right, which tries to model shocks. Our World Economic Outlook, the report that looks at the global economy, which comes out at the same time, used a 2 percentage point cut in world growth as its shock. So it said, well, what if the world, if as a result of uncertainty, difficulties in the Eurozone, what if world growth were not 3.5 to 4, but 1.5 to 2? And we said, okay, if that's the case, what does that mean for Africa? And that's the green line that you see in this chart. And what it shows is that, yes, it will affect Africa. Growth will be lower by about a percentage point. But it doesn't look very dramatic. And the reason it doesn't look very dramatic is probably twofold. One, we might have underestimated what a euro crisis means for the world. 2 percentage points decline might be a radical underestimate. I think nobody knows. This is the assumption we made at the time. So that could well be too conservative. But the other factor probably reflects the slides that I was just showing you, which is that the last crisis that hit the world, Africa was relatively resilient to it, and I think that's still the case. I think it's still the case that Africa has quite a few assets to draw on, whether it's low levels of debt, high levels of reserves. All of those are assets that Africa can count on. What Africa could also count on during the last global downturn was that much of its, a lot of its trade flows have shifted from, let's call it the traditional partners, Europe, the US, to emerging partners, notably China, but also India, also Brazil. In 2000, about 70% of sub-Saharan Africa's trade was with its traditional partners, and today it's slightly less than half. And this diversification or reorientation of trade helped Africa when the advanced economies experienced a sharp downturn. So will it help in the future? Well, that really depends on the severity of a euro crisis, since a very severe crisis in Europe will inevitably also affect China, will affect India, and we're already seeing some softening right now. So if the entire world goes down, I mean, and Africa is not going to be able to be different than that. And so, you know, there are risks, and they may well be somewhat larger than I'm showing you here in this chart. I promised you a few slides on natural resources. I'm going to go through them relatively rapidly in the interest of time. But it is a topic that I think is of immense, immense importance to Africa. Why is it of immense importance? Because the majority of African countries are natural resource producers. This shows you what they're producing. I mean, it ranges obviously from oil and gas to gold and diamonds and other things. And this map, if anything, is probably an underestimate. Some countries, such as Mozambique, which is not shown here as a natural resource producer, will be a producer. They found gas reserves, which I understand will make them the 10th largest gas producer in the world. They have more gas than Oman, I'm told. And that, of course, is a function of many things, including high prices, which make, for example, finding oil in Lake Albert, 1,000 kilometers from the sea in eastern Uganda, suddenly make that worthwhile. Uganda, by the way, is also not colored on this map, but they will be an oil producer in a couple of years' time. So it's important because many African countries depend on it. This chart tells kind of the same story in a different way. This shows you how dependent they are. In Angola, 100% of its exports are oil. It's practically the same for Equatorial Guinea. So you have many countries where more than a quarter of their exports are natural resources. This chart tries to show how important it is for government revenue, and you can see, compared to the other chart, that it doesn't seem quite as important for government revenue, and that really reflects a whole debate, which I'd be quite happy to have later, about how much benefit do African countries actually draw from their resources. The oil-producing countries typically do somewhat better. The minerals are often of limited benefit, at least to government coffers, and that's a real challenge. That's a real challenge, and it's one that we're working on very closely on a technical level, in terms of the fiscal regime, in terms of contracts, to try to make sure that those contracts and fiscal regimes are equitable between the investors who have their interests and countries who have their legitimate interests as well. A lot of the chapter talks about the economics of natural resource producing, and this really goes into the debate about what this means for competitiveness, Dutch disease. The chapter raises the question whether the natural resource curse that was so prevalent in the past is still so today. It doesn't come up with a very conclusive answer. It suggests that maybe it's less so today. I say it's not really a conclusive answer. I think we have to wait. You know, the problem with the natural resource curse is you have a boom-bust cycle. Well, we're now in the boom. And the question is what happens when there's a bust. What's happened in the past is that harmed countries significantly. And it's very difficult to say what would happen in the future. What is certainly true is that natural resource producers are much more subject to volatility. And this is a chart that shows it for so-called fiscally dependent economies. These are economies that where their government revenue accounts for more than 20% of their revenue comes from natural resources. And you can see that both growth and expenditure are much more volatile. I think on the vertical axis we have standard deviation. So the countries that are so dependent on natural resources have to be able to withstand shocks much more than others, because they're simply exposed to more shocks. And that has a lot of impact on policies. What can you do about it? Again, the chapter gets into quite a lot of detail. A lot of it is about good fiscal regimes, trying to make sure that a boom in revenue doesn't lead to a simultaneous boom in expenditure, so that you find a way in which to smooth spending, you find a way in which to put some aside so that you can absorb shocks when they happen. And the same on the foreign exchange side. Build foreign exchange reserves, because you are going to be exposed to more shocks. And the IMF recently put out a research paper on the optimal level of reserves, which is an interesting topic for discussion. And it does suggest that for natural resource producers, for countries that have less flexible exchange rates, which is often the case for oil producers, that you do need a very high level of foreign exchange reserves to be able to ride out some of the market volatility. So now I'm going to come now to what this all means for policy advice, and I will tell you right away that there is no silver bullet. There's no single piece of policy advice that's going to help Africa. But what there is, I think, and that reflects the diversity that you now see in sub-Saharan Africa. There are a couple of general guidelines that might be helpful. Overall, African countries are probably in one of three situations. You have those who have large fiscal deficits still, lingering from the crisis, are growing fast. They probably have an opportunity to rein in that fiscal spending and rebuild some of those buffers that served so well last time around. You also have countries where growth is more anemic. South Africa is a good example. And fiscal consolidation is probably not a priority. A priority is growth. And there, given the low levels of debt in many countries, I think the IMF is not advising to cut fiscal deficits, but to sustain them, to make sure that growth and employment remains high. And you have countries that are facing high inflation. And there it's important to bring inflation down. Monetary policy obviously plays a key role, but fiscal policy does have to help. And so in the Tanzanias of the world, which are probably at the upper end of the debt to GDP ratio scale, there is some reason to be fiscally conservative, as well as have high levels of relatively tight monetary policy, because you do need to bring down inflation. I covered briefly the special case of resource-rich countries. What I'd like to say here in conclusion is that for resource-rich countries, the challenges are really medium-term challenges. You really need to make sure, if you're a resource-rich country, that you use those resources to build long-term productive base in your country. And when we are talking to the authorities in countries that have recently discovered resources, whether it's Ghana or Uganda, and then soon Mozambique, this is their main objective. They don't want to end up in a situation where the natural resources drive out all other economic activity, as it has in some other natural resource producers in Africa. And for that, you need to have good institutions. And you also need to have good spending. So a lot of the debate or the discussion for us in natural resource countries is, how do you make sure that you're spending productively and not building the proverbial white elephant? I'd like to end with one of my favorite charts, which is this one. It's an optimistic perspective on Africa. Let me say a few words about what's in this chart. What we try to do is we try to look at countries, or in one case, a group of countries, since their takeoff. Takeoff meaning, when did growth start to increase in a sustained fashion? So when you look at economic growth, you try to find a structural break. And for example, in the case of the longest line in this graph, the orange one that goes all the way up to the right-hand corner, right upper corner, those are the ASEAN 4. So that's Indonesia, Thailand, Korea, which have been growing rapidly since 1973. Now look at the other lines, and in particularly look at the ones that are at the upper edge. There are actually two of them. I know it's difficult to distinguish since they're practically one on top of the other. But there's a purple line and there's a red line. And those are two African countries. That's Mozambique and that's Rwanda. Mozambique, since 1992, end of the Civil War, has grown between 8 and 9% a year. Rwanda, since 1995, has grown at approximately the same rate. So the story from this graph is really twofold. First, you have some African countries, Uganda and Tanzania are also in the mix, but Rwanda and Mozambique in particular, that have been growing as fast, in fact faster, than many of the emerging markets that we look at today in Asia as examples of rapid growth, poverty reduction. The only country that I didn't put in this chart is China because it didn't fit into the box. Otherwise, you have Vietnam, you have India, you have ASEAN, and Mozambique and Rwanda have been growing faster for nearly 20 years. So that's one thing, one lesson from this box. But the other lesson, equally important, is that if you want to really reduce poverty and lift living standards, you need to grow for a very long period of time. That's the story in China. That's obviously the story in ASEAN as well. 10 years, 20 years is not enough. 5 years, definitely not enough. And I think that's the lesson I'd like to draw, the two lessons I'd like to draw from this chart. One more, just to end on a note that is also a caveat. Fast growth, we all, when the IMF, we talk a lot about growth. Of course, in the end, it's not only about growth. It's not even mainly about growth. It's what growth makes possible, which is poverty reduction and employment creation, but also the incidence of this growth. And these are charts that came from our last report, where we try to answer the question, yes, we've had fast growth in Africa, but who has really benefited from it? And what these charts show is that in the fast-growing countries, we've included Ghana here as well, Uganda, Tanzania, and Mozambique in this picture, the poor have benefited. You can see that this curve, called a growth incidence curve, tries to break it down by deciles. So the poor are on the left-hand side of these charts. But in many countries, Ghana, Tanzania, Mozambique, the poor have benefited less. It's only in Uganda where the poor have benefited more than the average. And that is an issue. It is an issue because it raises social tensions. It's an issue because if the poor don't benefit enough, it's going to be very difficult for growth to be sustained. And it's certainly a topic that we are discussing in depth, for example, in Mozambique, where the authorities are particularly concerned to make sure that they want to continue to grow, but they also want to make sure that the poor benefit, and that they benefit as much as the rest of the country. And I think that's an important lesson for all of us. So let me stop there. Andrew, thank you very much.
Thank you very much indeed, Roger.